What's good, all my trader and investor homies? It's your boy Kevin. This is Touchdown Trades. I'm your trading BFF, your stock market bestie. And in today's video, we're going to talk about two high growth stocks that Cathie Wood and Ark Invest are absolutely loading the boat with, and that I am too. I like these stocks. They're both very high growth. I like one more than the other. And we're going to do a deep dive into these stocks, go over their business model, their business plan, their fundamentals, their growth outlook, and the technical analysis. So, why do we love Cathie Wood and Ark Invest so much on this channel? Not only do their investment motives align with ours, we love growth stocks, we love intuitive and disruptive technology, and they do too. Cathie Wood is probably the hottest 60-year-old fund manager out there, and I don't think there's any disputing that. But she's also a genius and an awesome investor. So when I see stocks that I like and I hear that Cathie Wood is buying them right after I do a video on them, that makes me feel good about myself as an investor. It gives me confidence in my investment and my stock choices. So in today's video, we're going to talk about these two stocks that Cathie Wood and Ark Invest are adding to their funds, to their ETFs. And we're going to go over them and talk about why they're disruptive, why they're innovative, and why they have massive growth potential. So stay tuned. Let's break down these stocks. And if you're new to the channel, this is Touchdown Trades. We talk about the hottest stocks in the market every single day. These videos do take a while to make, so go ahead and like the button down there. Just go like the button, start clicking all the buttons. And if you feel like you get something from this video, consider subscribing. And as always, let's secure that bag, by making sound trades and smart investments. Let's get it. All right, trader and investor homies, let's talk about two high growth stocks that Cathie Wood and Ark Invest are adding to their ETFs and that I see high growth potential in as well. Before we get started, if you're looking for a new broker, check out the link in the description after the video for Webull. They are doing a promo until the end of the month where if you sign up with my link and deposit $100, you get not one, not two, but 3 free stocks valued up to $1,600. You can't beat that deal anywhere out there. Nobody's beating that deal. Check it out after the video. Opendoor came out and said they're going to be doing a reverse merger with the SPAC IPOB. Social Capital Holdings is the SPAC that they're going to be doing the reverse merger with. If you're not familiar with Opendoor and their business model, we're going to dive into that in just a second. But first, let's go over the details of the reverse merger and the SPAC. Okay, so a transaction will enable Opendoor to continue to invest in growth, market expansion, and new products that will accelerate Opendoor's plan to become a digital one-stop shop for homeowners. The transaction values Opendoor, this is important, a value of $4.8 billion. So Opendoor is expected to go to market with a market cap of $4.8 billion. This is going to provide Opendoor with $1 billion in cash proceeds that they can use to grow and build their business off of, which includes a fully committed pipe of $600 million and up to $414 million cash. So if you're not familiar with what Opendoor does, they basically are a company. Say you want to sell your house and you don't want to go through the hassle of hiring a real estate agent, listing your home, waiting for these open houses to go through, and then maybe 2-3 months down the road, you finally get an offer, and then a month after that, you go through the closing process, and the whole process is probably going to take you 4 or 5 months to get your house sold. What you can do is you can contact Opendoor, and they'll buy your home immediately from you, typically at a discount. Then Opendoor goes in, they renovate the home with any required renovations, and then they sell the home again for a profit because remember they bought it at a discount because the homeowner didn't want to go through the hassle of the typical home selling process. So they're okay with not having to do the renovations, paint their home, clean the carpet, all that stuff. They sell their home for maybe 10% discount. Opendoor does all the work, and then Opendoor sells it for market value after they bought it for a discount. That's how they're making their money. Opendoor is currently held in the Ark Next Generation Internet ETF. ARKW is the ticker of that ETF, and it is currently the 29th biggest holding in the ARKW fund. They currently hold over almost 2 million shares with a market value of $35 million. So it is one of the biggest holdings, or one of the top half biggest holdings in the ARKW fund, and ARKW has consistently been buying this stock since the merger was announced. Their executive team is a team that is extremely experienced. Look at some of the experience these guys have. The CEO was been involved with Trulia. We have the president of Homes and Services, VP operations of Amazon in the past, also experienced with Airbnb. The founder, Ian Wong, was the head of data science with Square, and Tom Willinger, the chief product officer, was the VP of products at Netflix. So these guys have tons of experience with massive tech companies. Let's take a look at the revenue here. The revenue is very, very promising. You guys know I like to look at price to sales ratio when I'm looking to invest in a growth stock. It's my favorite metric for growth stocks because I think revenue is more important than net income at the early stages of these companies. Sure, net income is important for value stocks and stocks that have been, companies that have been established for a long time. But with these startup companies at ground level, we need to see that revenue growth. Then maybe 5-10 years down the road, we need to see that income start to grow as the revenue has grown in the early stages of the company. And Opendoor's revenue is sure growing. That is a fact. It is a upward trend that I like to see. In 2017, they had about $700 million in revenue. 2018, $1.8 billion. 2019, $4.7 billion in revenue. So if you compare the revenue to the market cap, you're going to be looking at about a 1-to-1 price to sales ratio. In my opinion, that is just too low for a growth stock. But here's one of the drawbacks. I'm sure the 2020 revenue is going to be down because they were not doing business during the heart of the Rhinoceros Rex pandemic. So they had to shut down their home buying operation during the heart of the pandemic, which is obviously going to impact the 2020 revenue. But it's one of those things like the company's going to survive. It's going to come out on the other side of the pandemic. So maybe it's a buying opportunity to get this thing at a discount. And then in 2022, 2023, when we're on the other side and the Rhinoceros Rex isn't a player anymore, we're going to see that revenue take off. So they say the U.S. real estate industry is ripe for disruption, and I agree with that. We all saw what Zillow did, what Realtor.com did when they came on the scene. It changed everything in the home buying and home selling process. No longer do you have those magazines with homes for sale in front of the grocery store. That's not even a thing anymore. If you want to buy a home, you're going through Zillow. Zillow disrupted the market, and now Opendoor is trying to do the same thing with the home selling and home buying process. The U.S. real estate industry is an industry that is valued at $1.6 trillion a year. And that is just an absolutely massive number. And this Opendoor says they want to get in there, disrupt that, and take a little piece of that $1.6 trillion, and they will be off to the races. So here's how the process looks like. This is what an Opendoor offer looks like. So a traditional home sale, you would sell the house for $303 to $340. You would pay a 5% fee, closing costs, all that stuff, 1%, hidden cost up to 4%. You would get net proceeds of about $270 to $300. With Opendoor, you're going to pay a 7% fee, a 1% closing cost, no hidden cost, and you'll get about the same, but it's an instantaneous sale. You don't have to wait on open houses. You don't have to wait on showings. You just sell the house to Opendoor and it's just immediate. First quarter of 2020, they were only in 6 markets, right? They were in Las Vegas, Phoenix, Dallas, Atlanta, Orlando, and North Carolina, and they did $2.7 billion in revenue. Now, they're expanding. They're currently in 21 markets, so we can expect that revenue to be substantially higher, right? As they gain more markets, they get more market share, they expand, and they get into every state in the United States, they're going to have much more revenue. That's just obvious. When you have more market share, you get more revenue. So I think that the growth is there. The growth outlook is obviously there. They believe that once they fulfill their market share goals, once they get the expansion underway, they think they can have $50 billion in revenue. That if they can hit that $50 billion in revenue, I see this as like at least a $30 billion company, right? Maybe a little bit less, maybe a $25 billion company. That means we would need to see some 5x growth in the stock price in order to hit those numbers. So the growth outlook is promising for this Opendoor. I really like the stock, but I do have a couple of drawbacks that I want to talk about real quick. Let's talk about a couple of the drawbacks about the revenue outlook for Opendoor. Okay, so the real estate prices are extremely high right now, and that benefits a service such as Opendoor because they are taking a small percentage of the sales price as their fee. So if a house is going for $200,000 average in a city, say they take 5%, they're taking a profit of what? $10,000. If the average house price drops to $150,000, their expected revenue is going to drop because the housing market has dropped. Right now, the housing prices are at all-time highs around the country. So obviously, a company like Opendoor is going to benefit from that. The housing prices are similar to the stock market. They go up and down, up and down. So if you're an investor in Opendoor, you are going to be somewhat dependent on the housing prices and their fluctuation. That's just something to consider. Number two, the Rona. Now, the Rona is obviously going to affect a company like Opendoor because it's going to affect being able to go in and view houses in certain states that are still shut down and in quarantine. But I think this is actually going to allow us to maybe invest in this company at discounted prices because the company is going to survive. It is going to make it out to the other side. And we will see vaccines 2, 3, 4 years down the road. Who knows how long it's going to take. But if we're getting this stock at a discount because it hasn't had the expected revenue due to having to close because of the Rona, then that's just a cheaper price point for me to invest in, I think. So those are just two things to consider. Let's take a look at the chart and then we'll move on to stock number two. So we have pulled back substantially after hitting highs of about $26. We're currently testing this support area at $17.50, and I see this as a prime opportunity to buy the dip, right? I think this $17.50 area looks very nice to buy in front of, so I'll be looking to dip my toes in this IPOB before the merger. The second stock that we're going to be talking about today that Ark Invest has been buying up like candy is DouYu International. Ticker DOYU. We are all familiar with what Twitch is. We all know what Twitch is because we use it. If you're a video game player, you probably get on Twitch and watch people live streaming playing their video games. And this is what DouYu International is, except the Chinese version. And we all know the video game market has been increasing exponentially over the last few generations. We've seen video games become more and more popular, and now live streaming them is becoming more popular as well. Ark Invest has realized this trend, and they want to get their feet wet with this DouYu International. Starting in October, they started buying this stock like crazy. In the beginning of October, they owned none of DOYU, but now it is currently the 41st biggest holding in the ARKK fund. They own about 4 million shares valued at $61 million. So ARKK has been buying this stock like crazy over the last month. DouYu International Limited is the largest game-centric live streaming platform in China and a pioneer in the esports value chain. We offer our platform on both PC and mobile apps through which our users can enjoy immersive and interactive games and entertainment live streaming, aka the Chinese Twitch. As one of the first game-centric live streaming platforms to make the foray into esports, we are strategically positioned to benefit from the proliferation of the esports industry in China. So if we take a look at a report done by iResearch, they say that the Chinese game live streaming industry is just getting started, and they have a growth chart laid out, and we can see that it is expected to grow exponentially over the next 3 or 4 years. We have a growth rate of 44% in 2020, a growth rate of 32% 2021 and 25% in 2022, and DOYU is positioned to take advantage of that growth. Hoya, another game streaming service, has agreed to buy out DOYU. They are both owned by Tencent, so basically the two are going to be merging to make a huge Chinese game streaming giant, and Tencent is a huge company. If you're familiar with Tencent, it is like I'd compare it to like the Google of China, the Google of China almost. They own WeChat. I believe they own WeChat. I'm not positive on that. I believe they own WeChat. They're just a big tech giant in China. So the purple lines I got drawn out on the chart is where Ark Invest started buying. They've been buying all October, and the stock really hasn't done much since ARKK started buying this stock. So I think we're getting it at a pretty good price. Sure, it is up big over the last year from sub $5, currently trading at $15. So we're up 300% on the year, but I still see the growth outlook as very strong for this stock. The first time we talked about it on this channel, it was trading at like, I think $12 a share. So we actually beat ARKK to the race on this DOYU, which is kind of fun to think about. But I still think there's a lot of potential with this stock, and I wouldn't be surprised to see it break all-time highs. I think the growth outlook in the Chinese game live streaming industry is there, and DouYu is positioned to take advantage of it. All right, guys, that's going to wrap up this video. I hope you guys enjoyed it. If you did, hit that like button for me. It helps to promote my channel to YouTube, tells YouTube that these videos do provide valuable information. Also, if you're not yet a subscriber, consider subscribing, and don't forget to check out the link for Webull so you can get 3 free stocks valued up to $1,600. That link is in the description. I'll catch you guys in the next one. Until next time, peace.